Welcome to Macro Hive Conversations with Bilal Hafiz. We aim to bring you the best in macro and markets thinking. To see our latest thoughts and analysis on the world, visit macrohive.com. Despite it being August, we published a number of big reports this week, from why inflation can rise to whether gold has peaked to issues around US mortgage delinquencies. We also are having some colourful exchanges on our members Slack channel too. If you haven't signed up to our free newsletter, make sure you do. You can email me at bilal@macrohive.com and I can add you to the list. Better still, you can become a paid member and access all our content on macrohive.com. It's a weekly price of a few scoops of ice cream, but much, much healthier. I always enjoy having investors as my podcast guests, and you're in for a treat in this episode. I have Shahraab Ahmad. He's a successful credit investor, and we have a frank and open exchange. As for his background, Shahraab was previously the CIO of the credit fund Decca Capital. Prior to launching the fund in 2015, Shahraab managed the Hutchin liquid credit strategy between 2008 and 2013 and allocated credit within the Hutchin multi-strat fund. From 2005 to 2008, he was a partner at Sailfish Capital, where he traded global relative value within credit. Prior to that, he was co-head of high-yield credit trading at JP Morgan. On to our conversation. So welcome, Shahraab, to our podcast show. Thanks for taking the time to have this conversation.
Thank you very much for having me.
It's always good to have investors on the podcast show. And one thing I always like to learn is something about their background as well. You know, I see that you started off at JP Morgan early on on the credit side. I guess the first question is, how did you first decide that you wanted a career in credit? Or was it just by chance that you ended up on the credit side?
So JP Morgan back in those days was a little bit more like a pure investment bank. This was in 99. And they paid for you to effectively go to university for 3 months where they trained you across all the various different markets. I don't think anybody does that anymore. And what happens is at the end of that, you take a test, and based on that test, you get to choose whatever desk you want to be on. And all I knew was that the internal JP Morgan people in my training program all wanted to end up on the CDS desk. I had no idea what CDS was. I had no idea what credit was. But when I knew that they wanted to do that, I wanted to do that. So through my scores, I guess, I was able to land on the CDS desk, which at that time was sort of a new and opening market. But frankly, I had no interest in credit. It simply looked like a good career bet.
And then when you joined the desk and you worked on the desk for a number of years, what was it about credit that made you first stay in that area and also do so well in that area? I mean, what is it about credit versus, say, the macro markets like bonds or FX rates, those sorts of things that you find particularly appealing?
So what I love about credit is that you can effectively find a macro theme, like not all the time, but most of the time, you can find a macro theme, but find a credit expression that is often it's more idiosyncratic, but also has a much better payoff than the same macro theme that you're playing. But the best part is that you often get a lag. So if something happens in the macro world, it's obvious. The macro instrument already gets priced, but the credit world will sometimes give you 2-3 days to 2-3 months to get into the same trade, knowing exactly what the macro guys already know, but somehow it hasn't been priced. That's what I love.
And I guess in the early days of the credit derivative market, many people at the time were quite skeptical about whether this was going to be a future of markets. I mean, did it feel to you at the time, this was, I guess, late 90s, early 2000s, that it was a Wild West in CDS, or by that time it was more established?
So the first part of the Wild West was the fact that CDS, right before I joined, at that time, every contract was a bilateral contract. And nothing was standardized. So you had desks full of lawyers trying to sneak in clauses that effectively made the contracts worthless. I think there's a famous case about some Russian CDS contract in the 98 default, where some of the contracts defaulted and some of the others didn't because one had the clause and the other didn't have the clause. And basically people spend 90% of the time trying to figure out what exactly they were buying or selling. But pretty much at the same time that I joined, all the banks got together, agreed on a standard contract, so that the contract no longer became the issue. It was really what were you trading and what price were you trading at.
And then you spent, I think, around 4 or 5 years at JP Morgan. Then you went over to the buy side. And what motivated that decision? Because often many people end up having a long career on the sell side where you end up running the desk, expand your empire within the bank, and you stay on that side. But it seemed like you I guess fairly early on in your career, you made that switch to the buy side. What was the reasoning behind that?
I think when you work at a bank and you have the career progression from being a desk trader to running a desk to running a group, very quickly the key skill set that you have is that you're a manager of people, that you're a motivator of people, and you're doing it across both the people that work for you through outside customers and reporting upwards. And I'm not a very good political person, so for me, I was never going to have that skill set, and that was never a race that I was going to win. But I did love investing, and I did love finding things that nobody saw. And so for me, the buy side was a natural place to be. Now, the only issue is that credit can often have really long lags between when something happens and when your P&L shows up. And when you're at a bank and a JP Morgan, if you don't make money for a year, but you have a good track record, they'll keep you around, right? Because you're just part of a big machine. When you work at a hedge fund and you're one of 5 portfolio managers that have to put up the numbers every month and every year, if you don't start performing soon, your trade might still work, but you've been bumped off long before you've gone to that point. So when I moved to the buy side, one of the things I really wanted to find was a mentor who would teach me kind of how to make that transition. And so I ended up working for a guy called Mark Fishman, who came from SAC, and sitting next to him for 3 years really taught me how to make that transition. If I'd done it on my own, I don't think I would have done very well.
And what were some of those things you have to learn to make that transition? I mean, how can you sort of manage your short-term P&L with those longer-term investments?
I mean, effectively, I think what everybody on the buy side ends up doing, away from a very few lucky or brave people, I would call them brave people. The brave ones, what they do is they find their best ideas, they put them on in size, and they'll ride through the drawdowns knowing that like the probability and the odds and so on are on their side. And also in a very smart way, line up their investors to actually go along for that ride. So one of the best examples is if you look at John Paulson in 2007, the way he set up the subprime trade was he made a dedicated bet. So everybody that signed up, when it started losing money, nobody could say, hey, what's happening? Can we stop out of this? Everybody else was doing it in commingled vehicles, and therefore their returns were a lot lower than what Paulson ended up with. So I think part of it is just understanding how much of a drawdowns you're willing to take, how much concentration you're willing to take, and then figuring out how to line up with your investors. And that's sort of a slightly longer learning curve, but that's part of the sort of decision tree you have to make pretty early on, where on the spectrum you want to put yourself.
And when you trade your portfolios, do you also trade some of the macro markets as well as hedges or just as sources of alpha or not? Or do you very much just stay with the credit?
Well, it sort of depends, but sometimes, there'll be big dislocation between where something is in credit and where something is in the macro land. I think the basic example was back in 2015-16, when a lot of the commodities had really big drawdowns. So oil went from basically 100 to 30, but a lot of the credit instruments didn't really move. So you could effectively put on credit shorts versus buying the commodities. And then very quickly at the end of 15, early 16, that trade reversed hard, but it took a while, but there was a massive dislocation. So you can either say, I'm just going to do one leg of the trade, or you can do both. But yeah, I mean, that stuff shows up a lot.
I mean, you've mentioned a few times about the time lag between, you could say, the ultra-efficient public market or macro markets and then the credits that you look at. I mean, that sounds like an inefficiency in some ways. Would you call that inefficiency, or is it there for a reason? And it's not, I guess, really an arbitrage either. And also, has the sort of the time lag been shortening as more money has gone into the credit space?
I think the time lag in some ways has actually been increasing, because if you think about credit back in, say, 2000, you had dedicated investment grade funds, you had dedicated high yield funds, long only, that weren't big, but not that big. You had hedge funds, but you had no central banks and you had no sovereign wealth funds. Now you've got all 4 of those, and all 4 of those, almost by virtue of what the markets have done, have become long only type vehicles. So if you have XYZ crappy company, but it looks okay on the surface and it's got a decent rating, the number of people that have to automatically buy that bond, no matter what happens, is pretty big. And here you are on the other side, some sort of dinky little short seller who nobody's ever heard of. And you're thinking, hold on, this company's underlying business is about to get washed away. For a while, nobody cares. And then at some point, something happens. It either gets into the news, or the ratings get downgraded, or the earnings and cash flow become so bad that the buyers can't ignore it anymore. But the momentum of that buying can carry on for a very long time, and it's only gotten worse.
Okay, yeah. So from around, say, 2007 onwards, you were kind of your own lead manager, and then you moved to Hutchin Hill in 2008. What was the motivation for that transition?
Unfortunately, it had nothing to do with me. So Sailfish was probably the best place I've ever worked at. It was an amazing team. But unfortunately, they had a guy that was doing mortgages, and he was like your standard rates arbitrage mortgage type guy. And he, we can debate how the trade happened, but he sort of got himself into a big subprime position, which then blew up the fund. So it wasn't my choice to leave Sailfish. I mean, Sailfish, in my view, we had all the best shorts at the end of 2007. We were short Bear Stearns, we were short Countrywide, we were short Lehman. I mean, basically, we had the entire list of everything that blew up in 2008. And we had to unwind the fund at the end of 2007 because the mortgage book blew up. So, if that hadn't happened, Sailfish would still be around today, and it would probably be a $20, $30 billion fund.
And so you were at Hutchin Hill during the global financial crisis.
Yes. I started in May of 2008, literally just as it was about to restart. It was perfect. It was the time it could not have been more perfect.
What position did you put on around that time? Did you feel you had sized the positions correctly?
Yeah, so my basic thesis at the time is that the US financial system, through losses in subprime, was effectively bankrupt. And every time you've had a financial system that's bankrupt in the past, one of two things has happened. The system has gone bust, and every company in the space goes under in one way or the other, or the government comes in and bails out the system. And so effectively, what you're trying to find is a set of trades that work in either scenario. So I'll give you one of the better trades that we had. If you looked at Bank of America and Citi back then in 2008, they traded only 5 basis points apart, but Citi had a giant CDO, CLO, subprime book that effectively, if you marked it to market, wiped out the equity of the bank, and Citibank was bust. Bank of America, on similar assumptions, was still basically solvent. So you could short an insolvent bank and be long a solvent bank and pay only 5 basis points. And if everything went belly up, Citigroup was going to go belly up much faster than Bank of America. And if everything was okay, you'd only lose 5 basis points. Who cares? So those were the kind of trades that I was looking for, effectively saying there's only 2 states of the world. So I want to find trades that basically make a lot of money in one or the other state, but don't lose too much money in the wrong state.
Looking at the world, I guess that was a crisis you were thinking about. But in general, is that the way you like to look at the world? Kind of look at sort of 2 scenarios and try to price them accordingly? Or was that just related to that specific moment in time?
So in an idealized world, the way I think of credit is that there's a bunch of stuff trading at par that's got issues, whether it's outright fraud, over leverage, or business risk, or business disruption. And it's trading at par, and for some reason, the market doesn't seem to understand what the risk is. And then there's a bunch of stuff trading at between 0 and 25 cents, where the company's already gone bust, it's already had the fraud, it's already had the issue, but there's an underlying business that can be easily rescued, and that 25 cents can become 100 cents. So in an ideal world where you had no mark to market and you could keep your trades on for a very long period of time, those are the only trades you would do. So obviously we don't live in that world, or I don't live in that world rather. And so then you figure out, well, what's the more real world version of that, and how do I put that on?
And you feel as though there are always opportunities in both of those buckets any point in time?
The investing world that I live in, it's either pouring gold or like you're in a desert and you're about to starve to death. I mean, it's sort of on and off. I mean, right now is a perfect example of, if you ask me right now, do I have 10 good trades? I don't have good trades. But if you ask me in April, I had 100 good trades. So the world can change very quickly for this kind of investment strategy.
And going back to 2008, so around the height of that crisis, so when Lehman's defaulted and the sort of ensuing period after that, how was that experience for you? And did you have any idea it would be as extreme as it got?
The reason that 2008 for me was actually kind of easy is because I lived through 2001 and 2002. So I don't think many people outside credit really think of 2001 and 2002 as some sort of scary time when like the world is about to end. But if you think at 2001, one of the biggest corporates in the US, Enron, defaulted and the bonds went to 10 cents. And then WorldCom, the biggest IG issuer, defaulted and the bonds went to 13 cents. And effectively, every credit investor said, I can't trust any books anymore. I'm going to throw everything out the window and sell everything. And if you've lived through that world, and that world kind of almost happened very quickly. For instance, the WorldCom accounting scandal only lasted literally 3 or 4 months. So it was almost a shock. Whereas the subprime crisis, even in 05 and 06, people were talking about what was eventually going to happen. It took until late 08, but you had plenty of time to be ready and understand the companies and understand and how this might play out.
And you spent, I think around 4 or 5 years at Hutchin Hill, and then you launched your own fund in 2014.
Yeah.
Launching your own fund, that's an important transition as well. What was that experience like?
So I think the biggest learning point from that in terms of launching it is that investors are, for very good reason, very, very cautious. So nobody ever wants to give you the first dollar. And I can understand why. It doesn't, from their incentive point of view, it doesn't really make a lot of sense. So to run a hedge fund properly, to be able to pay all your costs, you need to have at least 250 million. And so when you launch with 50 million or 100 million, you're effectively launching a money-losing business, and you have to be willing to underwrite that for 2, 3, 4, 5 years until you get to break even. And so just understanding how that was going to work and having faith in yourself that you could both trade and take on that risk, where I guess the learning. When you're a portfolio manager at a hedge fund, you kind of think that the investing is be all and end all. But of course, the investing is only 25% of the game. And then there's another 75% of the game of simply raising the money and managing it and running a company and all those things.
And in terms of attracting money, one gets a sense as an outsider that your early performance is very important. So if you have a knockout 3 months, 6 months, 12 months, then money comes pouring in. So there's a path dependence there. Do you agree with that view?
So I used to think that as well before I launched. And I've had friends who've launched funds and have put up 20, 30% numbers for 2, 3 years and raised zero money. And I've had friends who've launched funds and put up 5, 6% numbers and are become, 2, 3 billion, $4 billion funds. And I think a lot of it is, I'll use the word hurting, and I don't mean this in a bad way, but I saw this from my own experience. You're talking to a large investor. For some reason, they finally say yes. Then a second investor who kind of never was really interested in the first place shows up 2 days later and signs on the dotted line without asking a lot of questions, simply because that other investor signed. So I think performance is important, but really what ends up moving the needle is 1 or 2 credible investors who sign on early. And once those guys have give you the stamp, a lot of other people show up very quickly.
And running your own fund, did you manage risk or formulate views differently to when you were a PM at a fund?
I was doing pretty much the same thing, except that instead of now doing 1 job, I was doing 3 jobs or 4 jobs. So instead of just running the portfolio and running a team of analysts, I was also doing the fundraising, and I was also managing the management company itself and doing some, compliance type stuff. And at the beginning, when things are small, it's relatively easy. Later on, it literally becomes a lot. And so I think when you look at successful hedge funds, what they've all done is very early on had people away from the main investor who handle all that stuff. So the main investor remains the main investor. And I always had that at the back of my mind. But one of the reasons that I failed at my hedge fund was that I was never able to find the second person and the third person who were credible and take those duties away from me.
And that number 2 guy or number 3 guy, what qualities do you need in that person? Is it just a pure manager, or is there something more you need?
I think you need to have a shared vision. So I think especially at a hedge fund, when you work at a bank, you basically work for that year's bonus. And you're very incentivized to make it to December with the right kind of P&L, with the right kind of reviews, and get paid and then move on to the next year. When you're working at a hedge fund, it's very easy to have the mentality, but that's where you end up with a very short career. You're better off thinking about how do I make this thing last 10, 20 years, because that's where the real payoff is. And finding somebody that shares that mentality, especially on Wall Street, I don't think is that easy. And also, I think that integrity is a big deal. And this is something that, people that I worked for before always told me, which is, make sure the people you hire have the highest integrity above all else. And I never really understood why they thought it was so important until I started doing it myself. Because what you start to realize is that unless you can trust the people 100% to always do the right thing, you're always watching over your shoulder, and then you've basically got a lot of wasted effort.
And I suppose even if they're a star trader or have an amazing performance, if you can't trust them, then the whole thing unravels, I suppose.
Yeah, exactly. And you're making a lot of decisions, and some decisions you don't ever have time to do the full due diligence yourself. So you have to trust that the person coming to you and saying, by the way, I looked into this. It all makes sense. It's all legal. Sign the dotted line here, and we're going to do this. Either you trust 100% to do that, person 100% to do that, or you don't. And if you don't, then you've got a big problem.
One of the things, I'm always intrigued by when I speak to investors is how they manage drawdowns and losses and large losses. So presumably over your career, you've had many, many period drawdowns, losses. I think from understanding the big VIX blow up in 2018 was the big negative period for you. I mean, how do you cope with those sorts of drawdowns, both from a trading perspective and then also psychologically?
I think the best example is David Tepper, right? So if you look at his career, he's had massive drawdowns. Obviously I've never worked with him, but this seems like a guy who doesn't ever blink, right? He knows that his trades are good. He set up his fund in a way where the trades are good and is able to ride that out. Or you have people who diversify in such a way that you never have drawdowns that big. So the issue that I had is that if you look at my sort of P&L from 05 through 2016, we never had more than a 5% drawdown. But there were times when we could have had a much bigger drawdown, but either mathematically it didn't happen, but a much bigger drawdown is mathematically possible. I mean, we were analyzing gross 25% plus throughout the whole period. So when you're analyzing a 25% plus, having a 20% drawdown is mathematically definitely within the framework. And part of it is that your investors have to understand that. And I think we have done a very, very poor job of communicating that, saying, listen, this is the vol of the portfolio. And obviously, given the vol of the portfolio, there are going to be situations where we are down this much. So I think that communication and that education is something that we definitely failed on.
And in terms of when you do suffer a big down day, whether it's 1% down or 10% or 5%, I mean, the day after, do you see the next day as a fresh day, or do you still find that there are scars left over from a big down day?
I think it depends on why you lost money. So I'll give you an example. In 07, I was having a very profitable year. But in August of 07, we had we had a pretty major drawdown. I mean, sometime over the summer of 07, we had probably a 20% peak to trough drawdown. And during that entire time, my stress level was pretty much zero because we had done the work. We knew the underlying trades were good. Yes, we had given back a lot of P&L, but I knew that when these trades hit, we would make that all back and a lot more. So your underlying conviction in the P&L, in the trade and your thesis makes a huge difference. And even though we had lost money, nothing that had happened had changed view my original thesis as incorrect. Now, on the other hand, if something happens that either you didn't expect, but more importantly, that changes the underlying thesis, that's when I start getting worried and stressed. Because now you've taken the loss, okay, fine, but has the thesis changed and so the trade doesn't make sense anymore and you should cut your losses and run? Or is your thesis still intact and you should keep the trade and it's going to come back? And to me, that's more important than sort of managing the position, because it's easy to cut positions, right? It's easy to take losses, and that's how you end up with effectively a low return profile. But understanding when you're correct and when the market is wrong versus when the market is right and you're wrong, I think that's the key. And that just comes from having the conviction in the trade, and conviction only comes from having done the research.
And when you say you've done the research, I mean, how do you go about doing your research? I mean, do you do it yourself? Do you have a team? Do you read other researchers? Because the opportunities you look at are often very micro and opportunistic.
I think a lot of it comes down to triangulating. No one person or no one source is ever going to give you enough information for you to say this is absolutely true. On the other hand, if you're able to use quite a few sources and none of them give you the full picture, but they all give you parts of the picture, and when you put that picture together it triangles into the answer that you were looking for or not looking for, that's what gives you confidence, because you have diverse sources, they're not connected, they all point to the same conclusion, gives confidence. On the other hand, if you're relying on one piece of information or one source of information to give you that picture, that's when I find the hit ratio goes down considerably.
And what do you think of, say, sell-side research? Obviously, the street produces a huge volume of research. Do you consume much of that? Have you found that to be helpful? Is that part of your sources?
Yeah, I love sell-side research because in my view, people that are 90% right or 90% wrong are equally valuable. So all you need to do is find the people that kind of have that hit ratio. So, I mean, this is less so in micro, but in macro, I've found there are people that are constantly coming out at the wrong time, pitching a trade, especially after it's had a massive run. And that to me is always a signal of like, oh, now I can see how a big reversal can happen for XYZ reason. So what I don't find helpful is when there's a new research and I don't know the analyst and I don't know the bank and I read it, because I can't put it into context. On the other hand, if I've read an analyst for the last 6 months, last 2 years, and I know where he's coming from and I know what his biases are, I care less about his conclusion and I care more about his insights. But if I know his background, I can put that all into a framework. If I don't know who he is and I don't know where he's coming from, that's literally impossible.
And how do you deal with the general day-to-day news flow and watching prices? Because often many investors and traders, it's quite natural to start to watch the screen a lot. How do you manage that information from that side?
So this is going to sound really bad, but I tried not to read the news. What I try to do is I try to create communication with groups that filter the news for me. So whether it's email groups or WhatsApp groups or Bloomberg groups, there are groups that you can get into that can often give you a very good filtered view on that particular subject. So for instance, I'm in a group that all they talk about is gold and silver. And frankly, I know nothing about gold and silver and kind of really don't care, but I sort of care. But I find that spending 15 minutes in that group on a daily basis gives me an informed view of gold and silver that 3 hours of research on my own every day would not give me. So anything that I'm interested in that I want to get into, I try to create that information flow for myself and use that as a filtering mechanism. Now, of course, that means you're limited to what you can look into. So if I want to look into a German company or Italian company or a US company, that's very easy. If I want to look into a Malaysian company, that's very, very hard.
And earlier you talked about one of the challenges when you have a drawdown is when the thesis changes, when the narrative changes, and you're trying to work out whether you should stick to your thesis or not. And obviously we've had a huge shock this year with COVID. How do you think about COVID? What do you think has changed? What's the same? How does it affect the way you're investing?
Yeah, so COVID was interesting. So out of pure luck, I went into COVID all cash, nothing to do with the markets. I just had other things that I needed to do, so I was all cash. And then when COVID hit, I sort of did some research back into how China and Hong Kong reacted through the SARS epidemic. And if you look there was basically a short period of very sharp losses. There was really no central bank intervention, government intervention, but the markets came back very quickly because SARS got dealt with. So my view, which turned out to be wrong, was that COVID would be like SARS and things would come back to normal very, very quickly. But I also knew, given how the Fed had reacted in late 18, early 19, that they would come to the rescue of the markets very, very quickly and in a way that was unprecedented. So I could bet on the Fed, and I thought I could bet on the SARS-like analogy. And so my view was that when the markets tanked, you needed to buy risk, and you needed to figure out what kind of risk you wanted to buy and how. So I pretty much got myself fully invested in late March, early April. It turned out the SARS analogy version of my COVID analogy was totally wrong, but my Fed assumption was correct. And so that sort of worked really well. But my thesis for a little while was we will get back to normal. And actually now I don't think we'll ever get back to normal. I just think that people's behaviors now changed.
I remember we had a Macro Hive roundtable dinner. I think it was back in January, and you came to that dinner, and there was a massive divergent views at the table. There were a number of people who were adamant that COVID was a massive game changer, and there was another segment that were kind of arguing that it wasn't such a big deal. And now we know so much about COVID. It's also useful to go back to the early stages of COVID and remember how we were all thinking about it back then.
I think part of it too is that if you had COVID back in 2002, 2003, the technologies that we have today didn't exist back then. So almost by default, people were forced to go back to normal and deal with it. But now they have a choice. And companies also are finding that, hey, by the way, that sort of mid-level guy that used to come into the office and consume a desk, we don't need him at the office anymore. He can work out of the suburb 50 miles away and we can pay him 50% less. And that works out for everyone. So to a certain extent, we have choices now, and those choices are being made. So even as recently as 8 weeks ago, I thought we would go back to a very normal world very, very quickly. And now I just think we're sort of in this mishmash of pre-COVID, post-COVID world where things are going to happen on a very individual level.
And in terms of changes in the world that you think there are potential investment opportunities for, I mean, what types of things are you thinking about?
So the one that is really high on my list right now is New York real estate, especially New York residential real estate. So London, when I moved here in 2014, I had some very smart guys tell me London real estate never, ever, ever goes down. And then Brexit happened. And on a currency adjusted basis, you could buy stuff that was 50% off. And I made some of those investments in 2018, right before the election. And London has recovered really well. I think part of it is some Hong Kong money coming in, but I think people also realized, you know what, Brexit didn't change things that much. And the same kind of scary stories that I was hearing about London in 17 and 18, I'm now being told about New York. 2-3 guys a week tell me they're leaving New York, they're moving to Miami. People are selling their apartments down to whatever bid they can get. You know, I'm being told that Midtown Manhattan will never come back. No one wants to live in a high rise, et cetera, et cetera, et cetera. And when those kind of stories get told to me about a prime asset, my ears perk up. So I'm not telling you yet that this is a buying opportunity, but I do think now is this time where you really have to start doing your digging. Because without doing the digging, you're not going to see it. But I can see a scenario where New York has had a major recovery in the next 3 years, and at these prices, with a levered mortgage equity, that could end up being a real return.
And so you do have faith in a city like New York to, in the long run, still remain a vibrant city.
So I think New York has two issues with it, right? So one is that it's been the most affected by COVID. Everybody lives in large buildings. Everybody works in large buildings. So it's kind of the most COVID affected urban space you can get. And two, sorry for my language, but you basically have a communist mayor who wants to turn the place into Caracas. So those two things combined have now created a sort of migration effect that's very hard to reverse. And people are projecting that out and saying, in 2 years, we're going to get to a place where New York can't afford to fund itself, and it just creates, a very, very dangerous vortex. So I see that argument, but I can also see the argument where, $1 million apartment that used to cost, let's say, $4,000 a year because of mortgage rates and taxes and so on, to upkeep now because of lower rates and lower prices, that apartment might only be $2,000. And so for somebody that was making $100,000 a year, going from $4,000 to $2,000, is kind of pretty neat. And I don't know about you, but I would rather live in New York than Miami all day long. And, there's a certain energy there that I don't think any other place in the world has. And, money is something, but, how much you enjoy your life is also important. So I see how New York can very quickly get back on its legs. And I think it's starting to get priced very much the other way. So what you really want to find is sort of a lower end housing project where the developer's in trouble. He needs to sell it. The bank is about to foreclose on him. And stuff like that, if you can get leverage, can often be an amazing opportunity.
And what else are you looking at the moment?
So in terms of things that you can actually trade, the number one project I have is Venezuela. So there, you have a sovereign that basically has the largest oil reserves in the world. They also have large reserves of gold and other things. You have bonds that trade at 7 cents on the dollar. And if you work out the math where you get a regime change and you get a normal government doing normal things, these bonds can easily recover somewhere between 30 and 70 cents. And if you look at the Ukrainian recovery, you had a situation where you got a haircut, and ultimately you ended up having one of the best EM assets over the last 2 years. So the issue with Venezuela is that US people cannot invest. There are US sanctions. So if you're a US person, you cannot do this trade. So that basically takes out 50% of the capital in the world that would do this trade. And two, Maduro shows no sign of giving up. So there's no immediate catalyst. And who wants to buy a bond at 7 cents that's going to go nowhere, doesn't pay you a coupon? That's not a trade that shows up on 99.9% people radar. Yeah, so I can see several scenarios where this bond can make you 2 to 3x very quickly, and some scenarios where this bond can make you 5 to 10x on a longer time horizon.
And more generally, we've had this huge equity rally, particularly, say, in tech stocks since COVID last few months. And, obviously we're hearing all these stories of $1 trillion market cap and those sorts of things. Do you have kind of a view on the tech outperformance, in equities that we've been seeing?
I mean, I think it's easy for an old school credit guy like me to say, you know what, tech is overbought. Growth versus value spread is the widest it's been for 20 years. You should put on the mean reversion trade, et cetera, et cetera, et cetera. All I can see is that all the value companies you want to buy all have some sort of disruption risk, and the market is effectively pricing those in. So my favorite example is Ford and GM. These guys make all their money from pickup trucks. And if you look in the EV space, there's Rivian and a bunch of other guys that are bringing out EV pickup trucks. And I can see a scenario where the Ford F-150 goes from whatever market share it has right now to half that market share, simply because there's a bunch of EV competitors selling the same vehicle at the same price, but with much better metrics for several reasons. And suddenly the valuation that you bought Ford at got halved because of that disruption. Now, I'm not saying this applies across everything, but that risk is there across a lot of things. And I think that's basically what the market is pricing in. So really, my view is, instead of betting on growth versus value, what I want to find is cheap growth. What I want to find is companies that can be the next Amazon or the next Tencent or the next Tesla. And is there a structure that can get you into it? So, a recent example is Nikola. So, Nikola was a SPAC. They're coming out with semis that are powered by hydrogen fuel cells. And, the stock is what it is. But the thing that was interesting to me is that as part of the SPAC, you had a warrant. And the warrant is basically a 5-year call option on the stock. So normally, a 5-year call option with implied volatility is 100% would be a very, very expensive thing. But in this case, for technical reasons, they were giving you the warrant at 50% of the value of the intrinsic. So the intrinsic was $45. They would sell you the warrant at $25. So I think what happens is that when the SPAC gets launched, the owner of the SPAC unit gets 1 share and 1 warrant. And then the valuation, as the stock rallied, I think retail didn't understand what this warrant was. And so they were just buying the stock, and normal ARB guys were getting squeezed because if they bought the warrant and shorted the stock, the borrow on the stock was 1,000% a year, which meant that you would have had to pay 100% a month just to carry your stock short. So you couldn't ARB it. So you couldn't buy 25 and sell 45 and lock in that $20 spread. You literally had to just buy 25 and basically have a bet that somewhere along the way you would get paid out 45. And so that's why it was trading at such a massive discount to intrinsic. So my view was that, there's a certain kind of path that these growth companies take. You get the shares that got unlocked, you get some technology, they have Nikola World in December where they're going to tell you how many orders they got and so on and so on. We've seen this all in Tesla. But if you're able to get that long dated call option for so cheap, there were multiple ways to win.
And just for the benefit of our audience, a SPAC is a special purpose acquisition company, and it's essentially
it's a blank check company.
Yes, a blank check company. So it's a vehicle that's been funded to make an acquisition.
Yeah.
I mean, the whole SPACs world, it seemed to have really gained popularity in recent years. How easy is it to access SPACs? Do you need to be a real specialist or?
Yeah, so I think there's several stages. So one is when the SPAC gets launched. So there's effectively an IPO. So Pershing Squared did a SPAC recently, and there was an IPO. So if they were IPOing through the bank that you work with, you could get an allocation. And let's say intrinsic on the SPAC is $10.50. And at the IPO, you get it at $10.50. Now, usually with a brand name investor like Pershing behind that SPAC, who you think is going to buy somebody credible, you get a premium on that almost immediately. So that $10.50 becomes $12 within a week. So you've made a 10% return for literally doing nothing except putting in for this IPO. So that's sort of stage one. The stage two is that if you're an institutional investor, a lot of these acquisitions have what's called a PIPE. That's a locked up equity transaction that happens along with acquisition. So the SPAC that bought Nikola was called VTIQ. And when they were buying Nikola, they went out to a bunch of institutional investors and said, hey, come along, invest with us, and we'll give you these lock shares at also $10.50. The SPAC itself is trading in the public market at 12 or 13 bucks, but you're getting in at 10.50. And before you get in, you're basically able to do due diligence on Nikola itself to see whether you like the company or not. So you get a free look at the company. You get to buy the shares at a discount. Against that, you give up, a lockup. But that's the second stage where I think there's an opportunity because effectively you're getting a free look at this thing. So once a deal gets announced, you have, a binding commitment, but the deal hasn't closed. So during that time, so for instance, if you look at VTIQ, it traded up to 20, and then it traded down to 10, and it basically was zigzagging around between 10 and 20 for a few months till the deal closed. Then the deal closes, and suddenly Nikola goes from 20 bucks to 95 bucks in the space of 3 weeks. I mean, that was almost crazy madness, but it can happen. So there is a window where the deal gets announced, but it hasn't closed, where there's a lot of volatility. And if you like the underlying company, there's a chance to get in again. Because once the deal closes, you get a totally new group of investors who can now buy the stock. And if the underlying company is good, then you can get some real traction. Now, on the other hand, if the underlying company is bad, I mean, that's a totally different ballgame, and you're probably supposed to short that. But I've only been invested in terms of on the long side, and along the way, you get these massive discounts between the shares and the warrants, which are the call options. And sometimes trading between the two can create some real opportunities as well.
And earlier in our conversation, you talked about some of the new players that become very popular in credit markets, central banks, notably after 2008, 2009. We've seen QE and prospect of corporate buying program being ramped up, even on the US side. What do you think the implications are, say for the ECB engaging in buying corporate bonds, or the US or the Fed kind of suggesting that it may consider that?
Yeah, so I'll save that answer for somebody much smarter than me. I'll just tell you how kind of it gives me an opportunity. So what the Fed has done since March and April, which is basically anchored the corporate bond market by saying it's going to buy bonds under circumstances. We already know what that looks like because the ECB has been doing that for the last 3, 4, 5 years in Europe. And what that's done is has allowed very, in my view, levered or shady corporates to issue bonds at insanely low coupons. Now, I'll give you my favorite example, which is Wirecard, which is a German payments company that went bankrupt or is about to go bankrupt. In October of 2019, this company somehow managed to get an investment rating. Now, this is after 7 years of being stories out there in the public about how this company is effectively a total fraud. But only because the ECB has held rates to such low levels, the coupon on this thing was 50 basis points, half of 1%. Anybody that would have looked at this company in a rational context would have said, you know what, I need to get it paid at least 10% to lend to you. They were willing to lend to this company 50 basis points. You can't lose money shorting a bond at 50 basis points, especially when there's been many credible people that have done the work on this company to say it's a fraud. So when this bond came at par in October of 19, if you shorted it by June of this year, that bond was at 25 cents. And this is not the first time it happened. Steinhoff, which was another fraud that unraveled a couple of years ago, they issued a bond, a 1% coupon bond, of which the ECB, I think, owned 10 to 20% of the issue. And that bond went from par to 35 cents within 12 months of the issue.
So the opportunity here then is that through all of these buying programs and the support it gives to the corporate bond market, it basically inflates companies with terrible fundamentals and often fraudulent companies as well. And so the opportunity there is to identify those and then put the short trade on.
The way I think about it, just like in SPAC world, where they're giving away long-dated call options for free, the ECB and Fed are now giving you long-dated put options for free. That's basically what's happening.
In terms of your general sort of credit outlook, I mean, do you have a bias right now, or are you fairly neutral, or does it depend on region or sector?
I mean, my view is, at least in the US, if you're going to own treasuries, you might as well own IG corporates because you're picking up some spread. The Fed has basically told you that it's anchored that market. The US has pretty stringent accounting standards, so you have much less, risk of frauds and so on. And so, why would you own treasuries when you can own corporates? And to me, Apple and Google and Intel and all those companies have more pristine balance sheets than the US government itself. So that to me seems like a no-brainer. On the flip side, effectively, as we just talked about, there are some companies that have now been funded that are anchored where there's a considerable risk and the market is giving you that risk for free. That's basically my framework where I think generally in credit to be short is suicidal. I don't think you're going to make any money, but there are specific corporates where now there's a very interesting opportunity set.
Now, on a completely different subject, I'm a big reader. And I guess one question for you is, have there been any books that you have found influential in terms of the way you trade or invest in markets?
So there's one in particular that comes to mind, and it's a horse race betting book. It's called Picking Winners by Andrew Beyer. And what I like about this book is that he spends basically his entire, not entire, but a lot of the book talking about not how to pick the horses, but how to manage your bets. If you find a really good winner, how do you size that trade? But the most interesting thing that I found was that he basically tells you, and any investor knows this, but I don't know how much you apply it, is that there's only a few very good trades that come along every once in a while. And the rest of the trades are very, very small. On the other hand, you have to sort of keep yourself amused and engaged, otherwise you sort of lose interest. So he actually creates like a little trading fund for himself where he basically trades knowing that he's going to basically break even to keep himself amused versus figuring out how to do the larger bets. And I'm making it sound flippant, but what I liked about what that book told me is that basically your psychology about how you size and how you do things is so important. And so numbers are numbers, but we're humans. And obviously, I don't think we can act like robots. I mean, I think we all wish we could, but we definitely can't. And so knowing about yourself and knowing how you get yourself into trouble, and then how you can create little diversions that keep yourself out of trouble so you can stay engaged for the main game. I mean, that book, I mean, I read it back in, I think, 05 or 06, and was amazingly helpful to me going into the 07, 08 crisis, because it told me what's a big trade and how do I sort of keep myself amused waiting for the big one to arrive.
And again, on another sort of pet subject of mine, productivity or personal productivity, you obviously have worked in kind of high pressure environments and you're in the center of kind of all the various information flows. I mean, how do you make sure that you remain productive? Do you have any personal productivity hacks that you think work really well for you?
One of the things that I stopped doing was watching the financial news to a certain extent, because CNBC especially sort of makes you very, very, I don't know if panicky is the right word, but they sort of try to goad you into sort of like the whatever's happening at the moment. For me, it's all about creating filters, getting onto the right newsletters, getting into the right email distribution list, getting into the right chat groups. And from that, I find that it gives me a filter and a level of cushion that reading directly can often be very, very distracting. So for instance, before, when I opened my Bloomberg in the morning, I would read the stories in the top page. And then I started to realize that would just divert me from whatever agenda I had before that. So I kind of just stopped doing that and made sure that I had the news in a better filtered format.
It reminds me now, I should make sure I add you to all the various Macro Hive chat rooms and newsletters that we have. I'm sure you'll enjoy them.
Yeah, absolutely. Please.
So with that, maybe we'll wrap up the conversation now. I mean, if people wanted to follow your thinking or reach out to you, what's the best way for them to do that?
It's Shahraab@deccacap.com. My email is the best way to reach me. And then I have a small email distribution list where I share stuff that I find interesting with people. And I've had that list for about 10 years. And I've found that list to be an amazing source of information, because I'll sort of put some crazy idea out there. And then somebody that sort of is on the list that you didn't even think was involved will come back and say, actually, you're completely wrong for the XYZ reasons. Have you thought about this? And that will take you down a completely different route. What I love and what I always need is pushback and feedback, because it's easy to be inside your own head and something makes perfect sense. And then when you put it out to a bigger audience, the pushback that you get is really, really helpful. But the key is that the pushback, it's not personal, it's work. It's like, listen, I don't agree with your idea because I think you're wrong, not because I think you're an idiot. And I think when you're on social media, even though they're real investors, it can very quickly devolve into that because it's somehow the format makes that easy. Whereas you're dealing with people on a personal basis on email, it stays very professional.
Yeah, I totally agree with that. So with that, thank you very much, Shahraab, for a really enlightening and very varied conversation.
I really appreciate you having me.
Thanks for listening to this episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a rating and let other people know about the show. Also, sign up to become a subscriber to our research at macrohive.com. We'll be back soon, so tune in then.